everyone, and welcome to another episode of the Eitel Insights podcast. My name is Dean Eitel, and I'm the founder and lead analyst for Eitel Insights. Today we're going to be going over the Greater Vancouver Detached market update, but we're also going to recap what transpired in 2020 and give you some of our insights to what could be coming up here for 2021. Before we do get into today's technical charts and content, I just want to say a quick but sincere thank you to all of the subscribers that joined us in 2020. Our last podcast was able to achieve our highest view total to date, so thank you very much for that. With that said, of course, we appreciate if you continue to share this content with your friends, your family, and your social media platforms. And always give us that thumbs up. It's one click from you, but it does go a long way with us. So if you could do that, we would really appreciate it. Just a few things, media mentions before we do get into our podcast today. Recently, there was a Financial Times article that came out featuring some of the comments and Eitel Insights data, so we very much do appreciate that. Financial Times is, of course, one of the global leaders in business news and real estate, so it was nice to be back in that publishment. One other publishing that came up, or an article recently, just the other day, was the Vancouver Sun. It was a nice kind of piece to summarize what happened here in the detached market. So if you're so inclined, the links to all of our media features here will be in the description. And recently as well, the business in Vancouver called and asked for an interview. So we did record that. Again, the link to that interview is in the description if you're so inclined. One other event that is coming up here on February 5th is the Michael Campbell's Financial Outlook Conference. Now, it's been going on, an annual event for many years. This is the first time that Eitel Insights myself will be speaking at this event, so we are very much looking forward to doing that. Again, it is on February 5th. It is a virtual event this year, so tickets are available. They're roughly $250 if you want information. Once again, the information is in the description. That being said, we're going to get into today's content. We're going to start with the Greater Vancouver Detached chart. We're just going to put it up on your screen. And away we go. As you can see on the chart, prices have risen precipitously here over the last 7 months. Basically from the May lows of 2020, which equaled 1,586,000, up to 1,770,000 as of December. Now that May low, myself and others perceived prices would continue to tranche lower after the February price achieved 1,710,000. Then, of course, COVID arrived, lockdowns, shutdowns began, and prices again dropped from 1,710,000 in February to 1,586,000 in May of 2020. Since that point in time, prices have risen back up to 1,770,000. Now, what's important about this, it's re-entered into that top third of the market cycle. So it is only 3% lower than our historic high of May of 2017 when prices were at 1,830,000. So again, just 3% off of that price. Prices have risen precipitously here in the last 7 months. What's more important, or equally as important, is prices, the last two data points, have seemingly broken that longer-term downtrend. Now, this market has been born out of a lack of inventory, and we're going to get to that here shortly. But one other noticeable event on the technical chart is prices are attempting to remain with this staunch uptrend. You notice that they did break below there in the May price point of 1,586,000, but recently have reclimbed their way back up to just living right below it. So it is that kind of trend indicator, and likely will be broken, but we'll get to what the cause and effect here will be of the supply-demand factors shortly. Really what this price increase was born out of, in our opinion, it wasn't so much to do with the demand factors, but more to do with the lack of inventory, the anemic levels of inventory that were here in 2020. Just for comparison's sake, let's take the preceding 15-year average from 2005 up to 2019. The average yearly inventory, so the total amount of active properties in the year, averaged 70,082. So let's call it 70,100 for easy number's sake. And 2020 only achieved 50,225. Now that's down 28% from the preceding 15-year average. So that's anemic. That's historically low. In fact, it's actually it is the only year in the previous 16 years that inventory was not able to surpass 5,000 active listings in any given month. Not once, not one time whatsoever. You notice that's never occurred on the chart before. So when you see historic anomalies show up, that is really the impetus what drove prices higher here in 2020. Now, just for comparison's sake, let's take the condo market average inventory from the preceding 15 years and see how that affected out. As we know, the condo prices have been shrinking while the detached prices have been rising. Of course, that's from that work from home environment. Again, we're going to get to that. Just the comparison's sake, the condo preceding 15-year average was 62,650 active inventory yearly totals. For 2020, it was 58,545. total number of inventory. Now that's only down 6.4% in the condo market. So the inventory stuck with the historic norms for the condo market, for the detached market, completely contrary to our historical norms. And maybe you can see why that really drove price increasing. Even with that demand, which wasn't historic, it was historic given seasonality, but not really that demand that you've seen in years previous. Now, just going on years previous, the last time that we saw inventory at similar type levels was 2015. 2015 achieved 57,308 total yearly active listings. Now, what drove that inventory lower was strong demand. There was 17,372 sales during 2015. 2020 only achieved 10,838, if I'm not mistaken. We're going to get to that here. So 10,800 versus 17,300. You see the discrepancy with that demand versus just a 5-year trend. So was it demand born that increased prices like during 2015? As you can see on that chart there, the prices rose precipitously from 2015, peaking in 2017. That market was born out of a demand-based scenario. This market increase was born out of a lack of supply, which indicated that even this fifth worst sales in the preceding 16 years still was enough to make it seem like there was a strong demand throughout the market, when truly there was just limited supply, which enabled prices to go higher. One other, obviously key factor this year was that work from home movement coupled with low interest rates. Now, those two factors combined to equal pulled forward demand. Pulled forward demand simply means that people that were going to purchase possibly in 2021 or 2022 ended up purchasing in 2020. And what we saw that matriculate into is the tertiary areas or the entry-level price points really precipitously rising up. So there are 4 markets inside of the 20 areas of Greater Vancouver that are actually increasing month over month and creating all-time highs, historic highs, where there's only 3 markets that are actually 20% still below. Oddly enough, those 3 markets are historically market leaders. These areas that are increasing are historic market laggers. So will this continue? Well, it's going to really be born out of the inventory. If inventory can return to historical norms, we'll likely see the demand return to these, or the sales numbers return to these kind of trend lines that we've seen grow over the last 2 years. 2020 broke out of that, again, I believe out of the pulled forward demand, which will likely curtail once they've purchased one. They're one and done. It's owner occupied. So going forward, prices should curtail if inventory returns to historical norms and we see a peak of roughly 6,000 active listings in 2021. But we're going to get into the inventory here, and we'll share you some more key levels of entry or key levels of inventory that we want to be looking for to see if the prices will adjust accordingly. And we're just going to toss up the full screen here of the inventory, and then we're going to get into it. As you can see on the inventory chart, the inventory levels for 2020 were nowhere near their historic norms. In fact, this was the first time on the 16-year chart that inventory was not able to surpass even 5,000 active listings in any given month. A historical anomaly, and even equally as important, we actually finished the year at another historical anomaly. Even for December, December's your seasonality, it's your low time of the market, but there was only 2,700 active listings here in December of 2020. The lowest on our chart, and the high of 2020 was the lowest on the chart. So you can see how we equaled out to being the total year's lowest inventory, equaling only 50,225 active listings throughout the year. Now, how did that occur, and really is that going to continue into 2021? Because if it does, prices at these current levels could be sustained or with a potential of even going higher if these anemic levels of inventory continue. Then we'll have a growth cycle, an increased pricing market born out of a lack of supply, as opposed to the demand-driven market like we saw basically born in 2015 that increased prices all the way up during until May of 2017, peaking at 1,830,000. So 2020 was an odd year by any standards. There was health concerns born out of the COVID pandemic. Now that's a real life concern. What you'll notice is that, as we've explained in the previous chart, the monumental differences between the condo inventory and the detached inventory. Detached market is primarily owner occupied. So it made sense that you didn't necessarily want strangers coming through your principal residence during a health pandemic. Also, interestingly enough, historically speaking, prices with increasing prices, inventory tends to rise. So again, as we saw out of that 2015 high sales year of 17,372, what you'll notice here on the chart is that inventory continued to rise and actually peaked out in 2018 after prices had already met up with their apex. So during market lows like 2019, when prices hit their near-term low of this market cycle with average sale price of $1,468,000, you can see why that maybe didn't drive people to put their property for sale. Even with these increasing prices in 2020, there wasn't maybe enough of a rationale to put your property on the market if you did have legitimate health concerns this year. Going forward into 2021, now that prices are only 3% below their historic norms, with a vaccine on the way, with this new normal way to live, wash your hands, stay healthy, stay clean, it might curtail some of these negative effects that permitted inventory to remain at these historic lows. So just for kind of comparison's sake, we're going to show you here the preceding years of inventory. So again, 2020 totaled with 50,225 active listings. 2019 had closer to 70,000 active listings, and 2018 was our near-term peak with 75,500 active listings. The 2020 inventory total was 33% below the 2018 inventory. And so again, this is really why we see that these nominal levels of sales, and I'm actually going to correct myself from our previous number here. It wasn't 10,832. It was actually 10,382 sales that took place in 2020. So this low level, fifth worst in the preceding 16 years of sales, actually made it feel like it was strong sales born out of this anemic level of inventory. So going forward, if we don't have such paltry inventory, that number of sales wouldn't have even adjusted on this market. But because there was no inventory, this level of demand, low as it may be, was enough, coupled with low interest rates and that work from home movement, to increase prices over this preceding 7 months. Now, again, going forward into 2021, prices can sustain current levels or even go higher if we don't see these key levels be broken. One key level that was not a key level before is simply 5,000 active listings across Greater Vancouver. Once we tranche above that, likely during spring or summer, and summer maybe even surpassing the 6,000 active inventory, then you'll see prices start to wane. If we remain low with this inventory, prices are sustainable and could potentially even go higher, based out of a fear of missing out when there is no inventory to quash that fear. Because when there still is 5 people going after the one new property that shows up as an oddity, then yes, supply-demand factors work, right? And right now the supply-demand factors are saying that there's no supply, and even with tepid demand, prices can increase. One other level that is maybe key to watch is that black prolonged uptrend that we see that has held here over the recent history from its inception back in 2015, just was broke with again, 2,700 active listings in the month of December 2020. We should see, after an anomaly low like this, you should see a reversion come back up and see maybe a snap back up with the inventory throughout spring. Now, that being said, we're going through increased lockdowns/shutdowns, and so that might not be the case. If we continue to live in this world where you don't want strangers coming through your house because now there's a third generation of COVID or a fourth or a fifth, and this continues to trend into 2021, then that desire to have a larger building footprint of where you work, where you live, where you work out, where you do everything will continue to be a desirable trait, and those that can afford will continue to push prices higher. One interesting thing is we really got that recent employment data, and what you notice is that divergence. The maybe higher earning sectors are still strong. It's the entry level jobs, the entry level market of real estate that's hurting. Usually markets do work from their bottom and matriculate higher. This market seems to be strong in the detached and really abysmal in the condo. Again, will these trends continue in 2021? if inventory levels for the detached return to historical norms, unlikely. If they remain at these anomalistic levels, then it's likely. We're going to get into the sales here, and we're going to actually just share it on your screen. So as you can see on the sales chart, the sales have broken out of this 2-year trend where they remain below 1,000 sales in any given month. One thing to remember with the sales chart is, again, these sales data are taken from the completed transactions down at land title. So they're not actually from the accepted offers in a given month. So they might be lagging a bit, but these are the data numbers that we have to work with. So in August of 2020, these sales actually broke out of this 1,000 band where they couldn't achieve a higher number then. So August of 2020 achieved 1,108 sales, where October actually achieved 1,353 sales, peaking out the market. So what we really saw this year was spring pushed to summer, summer pushed to fall. Perfect example of that was the April sales totals of only 393 completed transactions. Now, of course, that's when we were dealing with our hardest hit, the new evolvement of COVID. So almost what we see, or what we are expecting to see in the inventory, where you see an anomaly data point low, such as this April in the sales total, you see a snapback much higher. So again, we peaked in October of 2020 with 1,353 sales. Now I'm going to have to correct myself again. Didn't have to correct myself in the inventory chart, but the sales totals for 2020 actually were 10,832 completed transactions. Now that number is below the preceding 15-year average. So when you hear about historic highs of month over month, September 2020 over September of 19, they are true, but again, we had this seasonality pushed out, so it might be a bit more misleading. Let's take the year as a whole compared to the preceding 15 years. Preceding 15 years actually totaled 12,748 completions or transactions taking place in the given years, while 2020, again, only achieved 10,832. So it's actually 15% below the average. So was it a stellar year for sales? No. And actually, it was the 5th lowest total of sales on this chart. So the only years that it was higher than was the immediate preceding 2 years of 2019, 2012, 2010, and 2008. The years that it was actually worse than was 2017, 2016, 2015, 2014, 2013, 2011, 2010, 2009, 2007, 2006, 2005. So you can see the number of years that it was worse than is a lot higher than the number of years that it was better than. So was this market born out of a demand basis? We don't see it that way. We do truly see that the 28% decrease of inventory compared to its historical norms was the driving factor that enabled this tepid demand, which again was higher than the immediate 2 previous years, but much below the historic average. That tepid demand seemingly was strong only due to the lack of inventory. It going forward into 2021, now that there's a vaccine on the way, we understand a little bit more about this virus and how it's transmitted. Not to mention the fact that the sales prices are back up to only 3% below their historic highs. That might be an impetus to actually sell this year, where and that will negatively affect that fear of missing out that was maybe proponent here later in the last few months. But we really see this as born out of that low interest rate environment, but more so coupled with that work from home movement. So when you wanted to, you just needed more for a footprint this year in 2020. Everything was done from home. You worked from home. You possibly taught from home. You were a teacher. You worked out from home. You did everything from home. So that desire for the larger footprint resulted in these increased prices because nobody was offering up their properties for sale. There's a large segment of the market that usually does downsize in any given year that did not take place in 2020. Simple fact is maybe they didn't want people coming through their property to put it on the market. And then maybe you didn't even have any help from your son or your grandsons out there because you didn't want them coming over and all of that. So all of these mitigating factors that led to 2021 or 2020's pricing increases will likely curtail in 2021 if we start to retract to our historical norms with the inventory. If we had normal inventory of around 70,000 active listings in 2020, this 10,832 sales would not be enough to have driven prices higher. But since there was only 50,225 inventory, yes, this demand was enough. So what we do expect going forward, again, from this sales total is maybe it starts to curtail because they are that one and done purchase. A lot of owner occupied has transmitted here. Also, not to mention, that the recent economic report where, the high wage earners, the high earning sectors are seemingly normal compared to their historical trends, where it's that entry-level job working your way up to becoming a high wage earner is severely impacted. And that's maybe why we see that completely divergence through the condo market and the detached market. One interesting point that was brought up recently on one of the podcasts was that usually the market does matriculate higher from the condo market's entry level, moving up, all the way to the finalized high-end values. That's really not what we're seeing here. We're seeing that divergence, the condo market being less of a demand and more increased, which of course negatively impacts prices. But here we saw that pulled forward to that the rush to have a larger building footprint to live and work out of, that was really born out of this pandemic. One and done. When you purchase, you're out of that market. So if we see return of normalized inventory, that will curtail prices similar to what is transpiring in the condo market. Also, as these condo prices start to decrease, you'll see that moving up or upgrading into a detached property becomes less feasible, which again should be or could curtail prices unless there is such competition with the demand because of the lack of inventory. So hopefully that gives you some guidance into what could be coming up here for 2021. Of course, we do appreciate it if you could give us that thumbs up, and look forward to our future podcasts. We are going to be releasing the condo market, but as stated, we are going to start branching out to the national markets as well. If you do have a request for us to cover on a future podcast, please feel free to leave the comment or reach out to us personally. Our email is in the description as well. Thank you very much, folks. Take care. Be safe.